But hello, everyone. Thanks so much for joining. Thank you really for your time. The presentation is about an hour 15 to an hour and a half long. If you do have any questions, please pop them in the chat box and we'll address them afterwards. But for those of you that want the CPD points and need to leave, you can leave after the presentation and then, we'll address the questions after that. But I'm not going to take too much of your time. So Paul, kick us off.
Great, thanks, Jess, and thanks everyone for joining, taking time out of your schedules to be here. It's been quite an interesting few weeks. Today, obviously, just going to cover the global economy. Where we see things, what's been happening. How we got to where we're at the moment globally, and then tapping into that, looking into the different asset classes, looking at our outlooks and valuations, and then we'll do the same thing on the local side. Local economy, local asset class outlook, and then we'll finish off with just a fund positioning and performance going forward. So like Jess says, if you have any questions, we will definitely, just pop them in the chat box and we'll address them at the end of the session. So if you look at it, guys, so on the first chapter, the first slide here, so what this is essentially showing you, these are the various different economies. This first column, 2020, this is so what the IMF does, the International Monetary Fund, every quarter does a world economic outlook where it takes, sort of overriding economic factors and basically does a forecast of where they see the economy to be essentially. And what they did is what these numbers in brackets shows, that was the world economic forecast in June last year. So sort of height of the lockdowns or just, a lot of the world was still going through massive lockdowns, big closing, restrictions on the economy. And that is what the IMF predicted these different economies would do in 2020. Now, the numbers in the green, or predominantly green, out of the brackets on the left, those were the latest estimates of what actual GDP was in 2020 looking back. And that was from July numbers July this year. So you can see over the course of a year, what was predicted, the economic fallout that was predicted due to the lockdowns was vastly worse than what actually happened and what actually ended up kind of happening in the world economy. I mean, if you look at your emerging economies, did significantly better. The world did significantly better. And if you break it down by region, you can see that. If you look at 2021, so these are the forecasts that the IMF made back in June last year for 2021. And then you look at the actual numbers for 2021, the forecasted numbers, and significantly better across the board. There's a few outliers, but significantly better. I suppose the standout ones are the USA looking very strong with growth. China's back on a strong growth trajectory, emerging markets coming out really strong, and the world as a whole coming out really strong, big recovery. So the initial dip that economists were predicting, that sort of V-shape, that very steep recession, didn't really pan out. You did have a recession, but it was a more shallow recession, and you're seeing a stronger recovery coming out of that. And you can see things obviously normalizing into 2022, but very importantly, the world still projected to grow at like almost 5% 2022 forecasted numbers. So it's quite interesting. So basically what you're seeing sort of very strong economic growth. And one of the big reasons for this is all the stimulus that was injected into these economies. If you look at this is the US Federal Reserve balance sheet. So as this number goes up, what that is the Federal Reserve buying fixed income instruments from the banks or from investors in terms of QE, and then that money, and so taking those onto their balance sheet, so that causes the balance sheet to increase, and then injecting that money into the economy via the banking system. So that is monetary stimulus. Now you can see this is the sort of stimulus, the three stimulus programs after the GFC, global financial crisis. You had the first one and then two after that. And then you had a sort of period of, I wouldn't call it austerity, but a sort of period of normalizing QE. And then COVID happened and you had this massive monetary injection. And that is still going on as we speak. So currently the Fed balance sheet is at $8 trillion. But with current stimulus still happening as we speak, that'll go up to about $10 trillion this year. So a lot of monetary stimulus coming into the system, and it's not just the US; it's worldwide. If you look here, you've got the European Central Bank balance sheet growing. This is multi-decade. So you see, Europe, Japan, the US. You can see these balance sheets just growing as they've stimulated their economies. But important to note, Charles, you've had an ongoing stimulus or ongoing ramping up of Federal Reserve balance sheets or Reserve Bank balance sheets before COVID even. So you had it, during the financial crisis. And these things have gotten bigger and bigger and bigger. So a lot of money is being pumped into these economies to keep them afloat, which is what I'm going to talk about today. Now, obviously, the big if you look at on the fiscal side, so the fiscal side is different. So that would be direct government spending. So either in the form of paycheck protection, TERS like we had in South Africa, or foregone revenue. So for example, tax cuts, and then also equity loans and guarantees. So taking equity positions in building projects, for example, or lending out for a building project or something like that. If you're going to go and build a dam or something, you're going to go and lend money. So this is direct fiscal money from the government. So not from the central bank, but from the government itself directly into the economy and not through the banking system. And you can see the developed markets during COVID, probably about 20 to 25% if you combine those fiscal injections. And, there's South Africa. But if you look at the emerging markets on the right, quite a bit less. They don't have access to the same resources that the developed market governments do. But you're looking at about 6 to 9% fiscal injection across the board there. So bottom line is you've had a lot of monetary stimulus through COVID. And that was one of the reasons you didn't see the sort of steep drop that we could have seen. So it's caused a sort of a better outcome in the short term or through 2020. This is just a heat map. You can see obviously the developed world, much more stimulus than the emerging world, just because of that, just because of access to capital essentially that they have that the emerging world doesn't have. So the big question I suppose on everyone's lips is and this has obviously caused massive fiscal deficits, budget deficits. You can see in the US here, massive 2020 deficit, and it's going to pay down some of that, but still it's running deficits in 2021, 2022. You've seen the Eurozone and you've seen China. So, the question now going forward is, obviously you have a lot of debt. So as you get these fiscal deficits coming up, that creates more debt. Now, if you look here, the blue line is the US debt to GDP, government debt to GDP, and the red is Chinese debt to GDP. And you can see the US is back at levels it was at during World War II. So, it obviously took on a lot of debt to fund the war effort over here. And we had kind of at similar levels. But if you look at Japan is at a significantly higher level, and it has been for some time. It has been for about 3 decades now. So the debt on its own, a lot of people worry about the debt. The debt on its own is not a concern if interest rates stay low, because the funding of this debt, these nations have much higher debt to GDP than say South Africa has. We're sitting at about 85%. And the reason, but the reason that people worry about our debt more is our interest rates are a lot higher. So our debt burden, our interest payments as a percentage of our budget are a lot higher. But if interest rates stay low, then this is quite manageable. And obviously in Japan, interest rates have been low for multi-decades. They've been in a disinflationary environment and running these massive deficits for a long time now. So the question now really is, well, what about inflation? What is going to happen to inflation? There's been a lot of money that's been pumped into these economies. What does that mean for inflation? And more importantly, what does that mean for interest rates? Because interest rates will affect capital or affect asset prices. So, we're going to try and sort of break it apart and kind of dissect the whole inflation story a little bit deeper. So if you look at this, the orange line here, this is in the US, this is money supply growth year on year. So as this grows, you can see more money is being injected into the economy. So what I mean by money supply or money stock is the amount of money that can be spent in an economy at any one time. Okay, so money sitting in savings accounts, money in bank accounts, that kind of stuff. And if you look at the blue is inflation. So if you look at the 70s here, the 70s had quite significant monetary supply growth in the US, and that was followed by periods of quite sustained high inflation. But as we've moved more forward, you're still seeing areas of where the money supply has kind of increased, but inflation didn't really come along for the ride. So the last few decades have been much more disinflationary than they were in the decades before that. Now, if you go forward and you run to 2020 and you look at COVID, you can see the massive, both through fiscal and monetary policy, this massive injection of money supply into the US. So, this is what people are looking at and they're saying, well, this is going to cause inflation. Now, if you look at the inflation print, you can see inflation has spiked. It's at about, the last print in July was 5.4%, significantly higher than what we've had in the last, 15 years before that. But now the question is this inflation going to be structural or is it going to be transitory? So, transitory meaning you've got these base effects. So you've got supply, price increases coming in, but very much due to the supply constraints that happened during the lockdowns, increased demand with people getting paycheck protection and things like that. And is it just going to be a sort of once off? You maybe have a few months of higher inflation and then it sort of flattens off, or you're going to have a sort of sustained higher inflation trajectory from here on, because that will obviously affect interest rates a lot more than just structural inflation would. So if you look at this, the money supply growth has already come down quite significantly, and that's as a result of a lot of these fiscal stimulus plans not being passed by Congress. So the Democrats are talking about running another sort of fiscal injection, and it's not really passing Congress, and there's no real need for it. If you look, the economies are opening up. They actually, I've shown you in the first slide, they kind of predicted to be, economies are going to start growing really quickly. So you don't need that extra injection of money, essentially, in the economy. So we're just going to break this down a little bit. So the first thing I wanted to talk about is if you look at this inflation, yes, and you say, okay, it followed, sustained periods of money supply growth. What's not on this chart is that you had two oil price shocks over that time period. So in 73 and 79, you had two massive oil price shocks that caused oil to go up 4 times. It essentially went up 400% over that time period, or 5 times, sorry. And oil being a massive input into inflation, it's an input cost into many goods and services, that was partly responsible for this. Whereas if you've seen the growth here, in money supply, you haven't really seen the same kind of effect on inflation-wise. So definitely something we're looking for, and we're going to break down to see what that can potentially have going forward, and what ramifications that can have. So if you look, let's first look at commodities, because they are, as I mentioned, an input into many goods and services. So if you look, the orange is a sort of commodity index. It has grown quite heavily, and you've seen, oil, copper, iron ore, all kind of rising since 2020, but still not anywhere near where they were before. Over time, you've actually seen these come down. So you have seen a rise in these prices, and you'll likely see prices being supported going forward. As the world, as you get this economic recovery, you will see continued demand for commodities. But I think a lot of the big jumps in price are through now. So does that translate into sustained or structural inflation going forward? It's not evident that it does, just because you've seen some big rising in price already. And I'll get back to this a little bit later. If you look at durable goods in the US, so durable goods are goods that people buy that they can essentially keep. So like, electronic equipment, furniture. So anything that's not a consumable is a durable good. And you can see durable goods have run really hard of late. And this part of the big inflation print that we saw in July was because of this. But now you got to ask yourself, well, what's the cause of this? Is it structural, or is it sort of just a transitory thing? If we look at it, and you go and you say, well, here, the orange is personal income. So this is US personal income, and the blue is retail trade volumes. Okay, so the amount of sales that you get, or the volume of retail. So what happened is, as COVID happened in the first lockdowns, you obviously had paycheck protection in the US paying out, and a lot of people didn't need that. They still had their jobs. They were working remotely. They were earning an income, but they still had this happening. So you obviously, with the first lockdown, you had a massive decline in trade volumes. And then that was immediately turned around because you had all this additional sort of income, this disposable income available to US consumers. Then that kind of flattened off, and you started seeing a flattening out of trade volumes. And then you saw the second and the third injections. And then those are both coincided with increasing trade volumes. So a lot of, if we look at this, you can see that it definitely coincides with increasing trade volumes here. As you get more demand for a good, obviously the price goes up. And if you have constrained supply, you had supply chains essentially shutting down in those initial lockdown phases. So you had no additional supply to meet that, no additional supply to meet that additional demand. So you had a sort of surge in prices, but it looks like it could be more transitory than structural. And since then, you've actually seen a decrease in real disposable income, and it's coming back down to trend levels. So if you look at, the sort of trends, you can see it's, excluding all the noise here, it's coming back down. So you will start to see trade volumes normalizing, and you'll see supply chains normalizing, and they've started to normalize already. And that should cause that to start normalizing as well. If you look at gasoline, gasoline, massive input cost to inflation, and you can see it tracks the oil price really closely, being an oil derivative. So the blue is West Texas oil, the orange is gasoline. You can see gasoline having a massive spike, but it'll track oil. So oil already started to kind of, the growth rates have dropped. It's already started to top out, and you'll see gasoline coming down. So another big factor there, gasoline has been a spike in inflation, but you'll probably see it tracking oil down. Another thing is, if you just look at, these are the growth rates, but if you look at the actual prices, so oil being in the orange, gasoline being in the orange, and blue being West Texas oil, you can see that although they've had big increases over the last few months, due to all the monetary injections and the supply constraints, over time they've actually come down. So over the last few years, these prices have actually come down. So they're actually deflationary over time, although they're in a sort of inflationary curve at the moment, upward curve. If you look at a longer term secular trend, they're actually coming down. And the big reason for this is substitution. So, gasoline and oil specifically now can be substituted for natural gas. So if you look in the 70s, you had those oil supply shocks causing oil to run dramatically. The US, well, the Western world was much more dependent on the Middle East for oil back then than they are now. So if you look at the Western world now, much more energy independent. They frack their own natural gas, for example. That is a substitute to oil. So it's, oil can't just shoot up because you're gonna have other substitutes that come in. And then you've also got the green energy. Whatever your view is on green energy, the one thing is that it is very highly subsidized and will be a substitute for traditional energy sources if they become too expensive. So you've almost got a cap. And that's why you've seen this sort of declining trend in the oil price over time. So if we just look at the breakdown, that 5.4% a little bit closer, and you say, well, the two biggest contributing factors are actually gasoline, which I've already talked about. And then, forecasting that to actually come down over time. And then the other one was used cars and trucks. So if you take that 5.4% number, a full third of it was just due to this number here, used cars and trucks being up 45%. So what happened was during the recession, what people did was they didn't want to buy new vehicles. So they bought used vehicles and pushed the price of used vehicles up. But obviously going forward, that's not a sustainable thing. I mean, obviously if they continue to run 45%, they'd become more expensive than new vehicles. So that's a very, very transitory thing. So if you break that out, you can basically lob about a third of this off here. If you look at other things like food, still very contained in the US. If you look at house prices, still very contained. So in the cities, in some of the big cities, the very metropolitan, cosmopolitan cities, you've got higher house price inflation than this. Some of them 15, 20, and that's been a 15, 20%, and that's been a multi-year kind of trend. But overall, house prices in the US, not anything to worry about at the moment. So, and also, if you take core inflation, which excludes energy and food, because those are notoriously they're quite volatile, core inflation coming in at 4.5%. So definitely you've seen an increase in inflation. And now, you've got a lot of people saying, well, is this going to be the next sort of big, and is this the start of this massive sort of structural inflation? It's not necessarily going to be the case, because a lot of them are transitory kind of components that are coming into that. Another thing to look at is, obviously, I showed you money supply before and saying, well, if money supply goes up, then inflation should follow. But if you look at Japan and the Euro areas, they have had extended periods of quite rapid money supply growth in their economies and just not able to get any inflation out. So if you look at Japan, it's been in disinflationary territory for the last 30 years, in spite of quite big monetary injections initially. They just weren't able to engineer any kind of inflation. And even with this last sort of increase in stimulus, almost going into a deflationary environment there. So for them, Japan's big worry is actually deflation, not inflation. If you look at the euro, similar kind of thing. They've had extended periods of money supply growth and just like no inflation. So inflation has been very muted. And these go back, this is since 2000. So it goes back, a couple decades. It's just not engineering inflation. So there's bigger forces here. And I think there's some demographics that we have to look into of why is this happening? Why is this monetary supply not doing what it did in the 70s, for example? Or why has it the potential to not do that? Because obviously inflation is a big risk, but you could have another risk that you get a sort of, like I say, a deflationary environment. So if you look at velocity of money, so what this chart shows, the orange is American money velocity, and then you've got Japanese money velocity, and then European money velocity. What's been happening is since the 90s, money velocity, what it does is it says, if you've got $1 in the economy, how many times does that dollar get spent? So if I go to the shops and I spend that $1, and then the shop owner takes that same $1 and goes and buys a car with it, then that $1 has been spent twice in a year. It's an annual number. So the velocity of money in that instance would be 2 times. So you can see during the 70s, all the way up to the 90s, you had velocity of money either flat or tracking slightly higher, quite vibrant spending of money. And you obviously, you had the two sort of inflationary shocks in the 70s. But what you've had since the 90s is in all of these major economies, you've had this sort of decreasing velocity of money. So what that means is that although money supply is going up, it's not being spent in the economy. It's not actually being used. So it can only be inflationary if it's actually being spent. So what is actually going on here? And what's happening is, you have aging populations in these developed worlds. So as people age, they spend less. So they have more savings and they spend less. Life becomes simpler as you get older, and a lot of that is what's happening. They're not buying new cars, they're not buying new houses, they're not buying new clothes. They're kind of just enjoying the simple things in life. And that's what starts to happen is you get this decreasing. So this is a very powerful demographic force that's not necessarily going to change anytime soon. And you can see, obviously, velocity of money fell off a cliff during COVID. If you look at jobs, so the orange is available jobs or job openings in the US, you can see it fell off a cliff during the initial COVID crisis, and then has rebounded back strongly, but still kind of in its long-term trend over the last decade of job growth. So it hasn't kind of broken a new paradigm or anything here. Now, the theory is that, well, if you have all these jobs, people, companies looking for jobs, if you had to overlay actual employment numbers on here, they haven't recovered as much. So they fell off, and then employment hasn't recovered. Employment hasn't recovered to the tops of where it was. Unemployment in the US is still higher than it was pre-COVID. And that's saying, well, if there's a lot of demand for jobs, but no one wants to work, then surely wages will go up. Now, that's not necessarily going to happen for a few reasons. The one is that the reason a lot of people aren't working at the moment is because they're getting paychecks. They're still getting paychecks. But as you see those paychecks start to dissipate, and I think there's less chance that the Democrats are going to be able to pass any new kind of paycheck stimulus to the extent that they want to anytime soon. It's very hard to justify it at the moment with projected 7% GDP growth next year. So as they stop earning those paychecks, they'll start going back into the labor force and start filling up some of these jobs. Another thing that you have to look at is if you look at the black line, that is average wages. Because what that's saying is if it pushes up wages, will that not be inflationary? But what you actually see is that wages increase, average wages actually increase in a recession. And it's because, unfortunately, the vast majority of jobs that are lost at the margin are actually low-paying jobs. Unfortunately, it's the poor of us that always get affected first when we have sort of economic downturns. It's just a fact of life. And what happens is, so you see a lot of poor people losing their jobs, then obviously the average wage will go up, but then slowly decreases as they come back into the workforce. You'll see the same thing happen here. So you see sort of wages spike, but they've already started coming down again. So that wage push as a push to inflation, it's unlikely that that's going to happen as people start to stop earning paychecks and start going back into the job market. Sorry, this is a bit of a messy slide. I'm by no means an artist, but I was trying to fit all these three on the slide so you can see them nicely. So what this shows you is also just another very powerful demographic trend. You've got the US, Japan, and Europe. And what those orange lines are those are population growth lines. And you can see population growth has been decreasing in the developed world pretty constantly for decades now. And because of that, like I said, you got aging populations. Now, if you look at the dark blue lines, those are total populations. So those are the numbers of people that live in these countries, okay? Well, you can see Japan topped out in its population like in the early 2000s. Europe and the US still have growing populations, but it's getting lower and lower and lower as time goes by. You can see, Japan's actually in a negative population growth at the been for a while, and Europe's nearing that. It's actually gone negative and then sort of slightly positive of late. And then you've got the States. That's the best of the three, got the best demographics of the three, but still, you can see it's dropping quite substantially. So the light blue line is a very important curve because that shows you how many people in these economies are actually working. What is the working population? What are those numbers looking like? And if you look at Japan, you can see Japan topped out. So Japan has less people working in its economy now than it did in 1995. And that is why they've had this sort of disinflationary environment. So you've got, 25, 30 years of a disinflationary force here that's coming through. Very hard to get sort of sustained inflation when you got these kind of demographics. Europe, and if you look at Europe's markets and Europe's economic growth, it's been pretty putrid over the last couple decades. And it's because, Japan's had no growth. Europe's also had hardly any growth, and that's also because it's basically got a flattening of people actually working in the economy. If you look at the US, it still had growth up till very recently, but what worries us is that is actually starting to top out now. And you're starting to seeing a negative. So although the population's still growing, as it ages, you're seeing less people working, and this is something to watch. So you could see, so our view is that you're going to see kind of structural inflation. You're going to see fairly big numbers coming out in the short term on inflation. But I think long term, we've still got these disinflationary forces at play. And you can turn, this could turn, and you could start seeing population growth. If the Japanese start breeding again, you could see population growth. But these are multi-year kind of trends that need to unwind. It's not going to happen tomorrow. So it's very hard to change these demographics. It's a cultural thing. So it doesn't just happen overnight. The last thing, you get what's called the output gap in economics. And what an output gap is it essentially measures the potential economic production of an economy based on its, its factory resources, its labor force, the demand it has for goods and services, the supply it has for goods and services. It puts all these things in and gets a sort of theoretical number of where the economy can go. And generally what happens is when you have a positive output gap, so that's what the orange is here in the US, that means the economy is running a bit hotter than it should be able to sustain over time. So there might be more demand on goods and services than what can actually be manufactured with the amount of infrastructure in place at the time. And generally that becomes inflationary. And you can see we had two kind of sustained levels of quite large output gaps before both those big inflation spikes in the 70s. But if you look more recently, you've actually had more sort of negative gaps. So where you have a negative gap is where the economy it actually runs cold. It doesn't run as well as it should be able to theoretically. Now you might have a recession that causes that. So a recession would come in, switch off the economy or tone down the economy a little bit, and then it takes a while to get back to its potential. And you can see, at GFC, you had a big recession and the US economy moved quite a way away from its potential output. And that's why you didn't have any inflation. Although you had all that stimulus over the last decade, you had no inflation, and it's because it was still in a negative output gap. And then it's kind of got back to where it sort of was where it should be, and then COVID hit. And it's had a big bounce since then, but still quite significantly below its potential output. So this is also another reason that you might not see sustained long-run inflation. Now you've got, the US is projected to grow at 7% this year. So you do have growth dynamics here, but you must remember the output gap itself has a growth rate. It's about 3.5%, 4% natural growth rate on the output itself. So it's still quite a way for this to catch up until you've got sustained large, here you had about a 4.5% output gap. We're a long way away from that. So something to just bear in mind. And if you overlay that with Japan, like I say, Japan had been in sort of disinflationary territory for the last 30 years. You can see predominantly it's run a negative output gap through that whole time. It's had very small times where it's had a positive gap, but nothing significant, nothing long lasting. And that's why it's been disinflationary. So if you look at sort of where do we see asset classes? So for us, like I say, you'll get structural inflation for a little bit, but the long-term inflation is much less certainty around that. Our worry is actually that you might start seeing disinflationary trends coming into play. And if you look at it, you think about, if you just say to think about it, you've got in the developed world, you've got interest rates that have been coming down multi-decades since the 80s. And the reason those interest rates have been coming down is that's accommodative, that's stimulatory to economies. If the economies were able to stimulate themselves, you wouldn't need interest rates so low. So the reason that interest rates are so low and where they are now is a side effect of the fact that you've got these lackluster demographics in the developed world. So, I don't see that changing due to COVID and due to this most recent sort of money printing. But obviously something we watch, it's a risk we're aware of, but it's something you obviously have to look in context. So if you look at consumer expectations of inflation, they're kind of expecting a similar thing. So if you look at their 1 year out, they're expecting inflation to sort of jump to 4.8%, significantly higher than sort of where it's been. But then on a 3 year outlook, starting to come back down. So, we kind of think that you'll probably see that as well. You'll probably see a structural increase, and then you'll see a sort of decrease, and you might see increased inflation from where it was, say, the last 20 years. But that's not necessarily going to raise rates. If these reserve bank or if these central banks can keep inflation managed. So the risk is this runaway inflation, and then these banks would be forced to raise rates, and curb that runaway inflation. But if you just had sort of inflation slightly higher, say at 2.5 to 3%, you're not necessarily going to see that these reserve banks raising rates anytime soon, because they actually want to keep rates low because they have a lot of debt. So if they can get sort of mild inflation and keep interest rates low, that means they can inflate themselves out of debt over time, which means the real value of their debt actually drops, and then they still don't have that interest burden. So it's quite an interesting dynamic. So you've got, and if you look at the Fed, this is the Fed dot plot. So every time the Fed the FOMC meets, they determine the interest rates. They ask all 18 members to forecast where they see rates are going to be, in the current year and then going forward. And you can see all 18 members still believe that you're going to have no rates increases in 2021. And then you start to see the sort of rates increases coming further out from that. So if you sort of had to aggregate it, it's the US has pivoted a little bit. So they were up until 2023 predicting no rate increases. And now they're saying, well, we might get 2 sort of 25 basis point rate increases from now until 2023. So slightly more hawkish than what they were a few months back, but still nothing, excuse me, to worry about yet in terms of where rates are going in the US. As I said, the one risk is obviously you have this runaway inflation, in which case I'll be forced to react. But I've shown you that the case for that is not as obvious that is going to happen based on what I've shown you previously. Another thing is, if you look at the bond markets, the Fed and these central banks are keeping yields low. So they are still injecting a lot of money, a lot of quantitative easing. So they're still buying a lot of these instruments and injecting that money into the banking system. And you can see in July, there was a bit of an inflation scare. So this is the US 10-year bond yield, and bonds sold off quite a bit, So this increase, the yield goes up and the price of the bond comes down. Bonds sold off quite a bit due to these inflation scares, but then turned quite quickly at the beginning of this year and have come all the way back. So a lot of that is, these banks buying a lot of assets, but you've also seen this sort of inflation fear almost dissipate. So as you're seeing this inflation coming through, the structural inflation, the market and the Federal Reserve are believing that it's going to be more structural or more transitory than sort of long run structural kind of inflation. If we look at equities, so, where I think you have seen, and like I said, you're getting more savings. So a lot of that extra income, if you looked at that velocity of money curve, not being spent, it's being saved, or it's being used to pay down debt. So the US consumer has deleveraged quite significantly. They're in quite a healthy space. They don't have a lot of debt, although their governments have tons of debt. The government can maybe learn from them, take a page out of their book. But if you look at, so they've paid down a lot of debt, but they've also saved a lot. So that money is sitting in investments. And if you look, you can see that if you look at equities, this is the S&P 500 Schiller PE. So this is the price level of the S&P 500 divided by the last 10 years of earnings. And the reason they use 10 years is just to get a kind of through the cycle type rating. And you can see the only time they've been higher than this is during the dot-com bubble, essentially. So this is quite interesting. It shows you that equities, you've seen inflation. So people are talking about inflation in the economy. You're actually seeing inflation in asset classes and capital markets. You're seeing equities just running really hard. So this is something we are watching very closely. It's very expensive. US equities in particular are very expensive at the moment. If you do a price to book or a price to NAV, excuse me. So that's, if you take assets minus the liabilities of a company, you say, well, if I were to sell all the assets and pay off all my debt, how much would I have left? And the average price of the S&P 500 company is 4.7 times that much. So very expensive also. So by different metrics, it's looking expensive. You say, okay, yeah, but there's a lot of GDP growth that's forecast, and that'll translate into earnings. What if you take forward earnings into account? So even, if you look at the Schiller PE, it's at about 38 times. If you look at the price to 1 year out earnings, it's about 22 times. So you can see massive earnings kind of come through, but still expensive on forward earnings. And this chart is quite descriptive, and it's quite predictive. What it's showing you is it says, if you were to enter the S&P 500 at this level, this forward PE, what would be your subsequent 10-year returns on that investment? And you can see at current levels, you're actually not getting a return 10 years at current levels. So on a forward PE of 22, the American market is expensive. We would much rather that it were down here. If you look at where it was at the bottom of the financial crisis, for example, forward PE over there was probably about 9 times. So you can see a lot cheaper, and that's why you had significant returns from there. But now, we're not at that place. So something that we're watching very closely. If you look at the rest of the world, so obviously America is the outlier. So like I showed you, it's got on a forward PE of about just over 22. It's quite different from the rest of the world. So if you look at emerging markets, which we quite like, emerging markets are on a much more favorable forward PE. But even places like Europe, Japan, the UK, they're all a lot better from a forward earnings point of view than the US is. So a lot cheaper. So we'll talk about emerging markets a little bit later, but that's a space we really like more than sort of the developed market equities at the moment. It's just based purely on valuations. If you look, this shows EM's emerging markets versus developed markets sort of relative performance. And you can see that the relative performance happens in cycles. So when this orange line goes up, that means emerging markets are doing better than developed markets equities. And the reverse is true as well. You can see during this sort of when commodities run, because emerging markets are generally more commodity export type economies, emerging markets tend to do well. We have seen a run in commodities, and I think, with growth, world growth projected to be upwards of 4% over the next 2 years, you'll see commodity prices being quite sustained, quite high levels. And you'll probably, it's a good environment for emerging markets to start to outperform developed markets. And you've seen the reverse for the last decade. So the decade before was the other way around. And the last decade, you've seen, developed markets have been the place to be, but these things turn. So we quite like the emerging market story. If you look at global property, we really like global property. We've held quite a bit of it, and it's done well for us, and we continue to hold it in our offshore portfolio. This just shows you the spread, the income spread, so the rental spread above bonds, above investment grade bonds in that economy. So it shows you at the US at the moment. So US property is at a 3% spread above what bonds are giving you. So if you look, bonds are giving you 1% at the moment. So the yields on property at the moment are about 4% a year in hard currency, which is quite nice, significantly above, fixed income, like I said, of 1%. So when this is, and it generally tends to mean reverts, the bond sort of proxy nature of property. So when this is high, it means property is quite good value relative to bonds. And when it's low, it's not good value. And you can see, before the financial crisis, you could see property was very expensive. And then obviously you had the property crash. But you can see now it's a lot cheaper relative to bonds. So we quite like the space, good yield pickup here. If you look just globally, sort of funds from operation growth in the property market is forecasted to be about 6%. And if you look at sort of yields, another 4%. So you could get sort of income growth of, 9 to 10% in hard currencies by investing in global property. So we quite like the space, and it's looking good value. Definitely a lot more valuable than equity, and showing a lot more value than the fixed income space as well. Just on that, obviously there's a story around e-commerce. So, the big story was during COVID, what e-commerce is going to kind of take out kind of traditional retail, because that's obviously a big story with property. So I printed you just a log curve here. This shows you the percentage of e-commerce, so total retail sales. How much is e-commerce of that total sales? You can see it's up at about 12.5% at the moment, and it's grown substantially over the last 2 decades from nowhere to quite substantial numbers, and it will continue to grow. But the trend, guys are saying, well, we're going to see a paradigm shift. When COVID happens and the lockdowns, you're going to see just this entering a new kind of growth trajectory. And you did initially see that as lockdowns happen. But subsequently, as economies have reopened, people have realized, they actually like to see people. They like to go shopping in person. It's a social, it's a cultural thing that you don't just change. And you're starting to see this trend actually go back to sort of normalized levels of where it was before COVID. So, a lot of people like to project these revolutionary changes, but, you still wake up, the sun rises, and you've got to pay your taxes. So, these things are often take a lot longer than what we think. So you did see a kick up due to purely necessity, but it is coming back. So very interesting. So I think, going forward in terms of property, I still think there's a space for retail, and we're quite bullish on just the property sector in general. If you look at the local economy, I think as stewards of your clients' funds, I think it's important that we cover what happened over the last few weeks. I think, it would be remiss of us not to spend some time on the recent social unrest. but it's important that we sort of keep a balanced view, especially for us managing money. You can't be emotional about this stuff. You've got to look at the facts, and you've got to look at what's happening underlying and try and distill it and put it all together. So, there's obviously been a lot of fear. So I'll talk about the negatives, but I'll also talk about what I believe to be some of the positives that could come out of the recent unrest. So if you look at, the negatives, clear negatives, everyone knows, it's all over the media, the failure of our security cluster to protect our citizens. If you look at the SANDF and the police force, late to the party, under-resourced, just not a good show, not what you want to see. If you look at, damage to economic growth, probably looking at 0.5% to 1% there. And I think, it's not really needed in a time where, SA's had quite anemic growth for the last few years. It's not a space it's not really a time where we want to see this, and that hurts. If you look at just the damage to private property, property and infrastructure, it's estimated it's between 20 and 30 billion, somewhere around there. And that's really resulted in job losses of about 150,000 people. Massive. And if you consider our unemployment rate was already 32%, our youth unemployment was about 63%, it doesn't help the picture at all. Damage to small businesses and the informal economy, I think this is crucial. It's maybe underappreciated a lot because, obviously as investors, we look at listed stocks, we look at the big players, the guys with the big balance sheets, access to capital, professional management teams, and a lot of human capital at their disposal. Those guys aren't insured. They were hit by this, of course. They're mostly covered. It's going to be a hit for them, but in a few months' time, they're going to be back. And that's why you didn't see asset prices moving around that much. The market understood that, is that it was a kind of transitory thing. But where you're really seeing a lot of damage is the informal economy and those small businesses. And you might even find the big companies, the big retailers, although they were hits in the short term, might come out of this stronger because a lot of their smaller competitors have just been blown out the water. It's going to be a lot harder for them to come back. So this is, unfortunately, the sad part of it. It's always, whenever these things happen, it's the poorest of us that get hit the worst. And it's that informal economy and that small business landscape that just takes the brunt of the damage. And this leads to loss of confidence. I think, we've already, if we're going to speak openly, I suppose we do have a bit of an immigration pandemic happening in South Africa again. You've got a lot of young people, a lot of people, economically active people that want to leave or are looking at going overseas. And I don't think the recent kind of unrest is it's definitely not going to send that in the right direction. It's probably going to increase that a little bit, which is highly unfortunate. So just worse loss of confidence. It does create further uncertainty around social stability. As I've said, you've got these massive numbers of unemployed people. And we were kind of thinking, we were wondering why it took so long. We were actually thinking you might see some unrest during the first or the second lockdowns of last year, and people started to wonder why they sort of had their, don't have jobs and don't have a chance to earn an income. But it took surprisingly long for it to happen. And obviously there was a political implication to this unrest, and there was a criminal element. And definitely there was an involvement from the sort of more radical RET faction, but the vast majority of those looters are probably just people that were desperate and hungry. And that's, it reflects that. It reflects the desperation and lack of opportunity for a growing number of our people. And the last thing, I think, unfortunately, it mirrors, but what we got to understand is it's not just happening here. If you look in the last 18 months, the US had very violent BLM riots and protests. Their capital was assaulted. So you had both sides of the political spectrum with social unrest. You've had unrest in Europe, they're pulling down statues in Europe last year. France is still going through riots. You've had the protests and the violence in Hong Kong. You've got Cuba and what's going on, anti-communist protests there. You've got even in Australia now, you've got anti-lockdown protests. So it's not the same violence you're seeing here, but there's just this increased social unrest. And I think it's unfortunately just a sort of side effect of people going into lockdown. It's just not a sustainable way forward. So thank goodness that these vaccines are coming and we can get some normality back, sooner rather than later. But if we look at the positives, I think big positive is, I think it was a possible final stand for what you're seeing as an increasingly desperate RET faction, the radical economic transformation faction, the Zuma supporters, the undemocratic, part of the ANC, the people that are trying to sort of gain power through force rather than at the ballot box. I think, you've seen this power grab over the last 10 years, and I think they're getting increasingly desperate, and we'll talk about it a little bit later, but there's a lot of, we forget there's a lot going on in the background. There's a lot of reforms. I think these people are increasingly realizing that, they're going to be held to task for a lot of what's happened over the last 10 years. And that creates desperation. And I think a lot of this was that kind of almost a final stand in a sort of fight back, because, I think they thought if they don't do something, they're going to be in trouble. So, I think for the ANC and for the Ramaphosa camp anyway, to hold fast and sort of double down on what they've been doing in terms of these reforms, in terms of tackling corruption, I think will send a very strong message to this faction. The constitutional integrity has been tested numerous times over the last decade and remains intact, and I think even strengthened. Zuma going to, who would have thought? No one would have predicted that Zuma gets 15 months in prison, for contempt of court a year ago. 4 years ago, no one would have even predicted that he would have been voted out at the NEC conference 3 years ago. So, these things tend to happen, and we forget that these things are happening in the background. But important for any democracy for that constitutional integrity to hold up. And fortunately, thankfully, it is holding up, and it seems to be very strong in South Africa. The SASRIA covered to this damage, SASRIA is going to cover about 10 billion, and reinsurance will probably cover close to another 10 billion. So a lot of this damage will be covered. It was concentrated to local parts of the country. It wasn't a countrywide, widespread riot, which I think, and the fact that it was able to be contained in those areas, I think is good. And a lot of that comes from the sort of moral reaction of broader society. People in their own communities standing up to these looters and standing together and standing up to the rioters, I think was very encouraging to see that sort of moral kickback against what was happening. And I think that ties into a sort of weakened ideological stance for both, I suppose the very far sort of left-leaning parts of our political, political landscape that's been quite undemocratic, that hasn't sort of really respected the democratic process. I think it's weakened their stance. If you look at the EFF, if you look at the RET faction of the ANC, I think it's definitely weakened their stance. They've almost lost the sort of moral high ground in terms of their electorate through this. If you consider they were the ones sort of kind of backing this, stand up, riots against the private sector, stand up against Ramaphosa, sort of, let's call him, he's owned by sort of big business and things like that, stand up for yourself, and that sort of left leaning kind of sentiment, I think I don't think they're in a good place going forward. I think it's actually hurt them. And the reason is because a lot of people on the ground are seeing this. Again, the poorest of us are always affected by this the most. It's not the middle and the upper middle class. It's the people that can't go and buy bread from their shop in their township, for example, that get affected by this the most. I think it's going to increase economic and political reforms. Obviously, some of the economic damage will be offset by reinvestment. So as SASRIA cover pays and you see rebuilding these portfolios, some of that damage will be offset. And I think it has improved public-private relations to an extent. I think the ANC has to realize, and it's realizing, we'll talk about it in a little bit more detail now, that business is not the enemy. Business, if you want to bring down that 32% unemployment rate, business is going to help you do it. And I think there's a few key things that we can look at that tie into that. If you look at the institutional reform that's been underway over the last few years, we forget about this stuff. I'm not going to go through all of it. You guys, we'll send this out to you. You can read it in your own time. But a lot happening in our SOEs. The big ones I'd like to point out to our SAA being privatized. That's a big one. It goes against sort of the ideology of the ANC. The ANC has been forced to realize that they can't solve all the economic problems of the country. They can't centralize everything. They need to go to the private sector. And the other big one is this 100 megawatts. I don't know if you saw it. It was kind of under-publicized, but the June numbers of the 100 megawatts increase in self-generation. So self-generation, you could generate your own power up to 10 megawatts. And now they've multiplied that up to 10 times to 100 megawatts. So it's still not for sale. You can't go and start up a plant and sell that. But as big businesses, as the miners, the guys that use a lot of electricity, they can go and start using alternative sources of energy and generating their own power. Amazon is already talking about doing that in the Cape, building its own solar plant. And that is it's a big symbolic stance, I think, from the ANC. You can almost say the ANC has, in a way, given up from trying to. I think you're going to see more of this coming through, and realizing that Eskom is not going to be this big behemoth, the centralized thing that the government owns that's going to have the monopoly on our power going forward. And this was, I think, a very big under-publicized kind of input into that. You know, Eskom, just on it, you know, is on the right path. I mean, it's still got a lot of debt, but less than what it had before. It paid off 65 billion rand last year. You know, another 35 came from forex gains, so that's just luck, I suppose. But it only borrowed 15, so it has paid off. If you take it, paid off about 50 billion rand last year. So it's going in the right way. Now, it still owes a lot of debt, but, you know, sometimes going from, you know, in investments, it's more about your path, the trajectory you're on, and the level you're at. You know, things going from very bad to bad can be a good investment, and just as things going from very good to good can be a bad investment. You know, so the trajectory is on the right path, and we've got to keep our eyes open to this stuff. If you look at corruption reform, also, you know, like I say, who would have predicted that Zuma would be in prison for 15 months a year ago? Ace Magashule being suspended or being arrested and then being suspended. So you can go through this in your own time, but just a lot being done in the Hawks. You know, a lot of arrests have been made. You know, there's a lot going on in the background from both an institutional reform point of view and a corruption reform point of view. Like I say, you know, that's, I think, one of the reasons you saw this riot. So, you know, generally you can have social unrest when you get sort of paradigm changes. And the paradigm can be going in a bad direction or a good direction. And I believe, you know, this unrest that we saw is actually a paradigm change due to going in the right direction. You know, you're seeing people I think a lot of the people that have made a lot of money in the last 10 years are getting scared. They're getting worried. If you look at our fiscus, so our debt to GDP, you know, those were the projections out up to 2028, 2029. That was the projections that Mr. Mboweni gave in the 2020 medium-term budget speech last year. So you can see the revise at the beginning of this year coming down. So you've actually not seen it. If you saw, you know, those initial projections, it was up higher, but you've actually seen the reverse happening. And this is for two reasons. One is you have had mining revenue, so you have had revenue increases. So can't give the government kudos for that one. That's luck. But where you have seen government sort of intervention that has helped this is cost cutting. So they have looked at cost cutting. They have looked at a bit more austerity. You know, I don't know if any of you have been following the wage negotiations that are currently ongoing, but it looks like the majority of the unions, the six sort of government unions, government employee unions, will accept. You know, as far as I know, 3 of them have already accepted the 1.5% increase. So that can be a win for us. You know, 1.5% increase it's well below inflation. So that can be a big win for us, which we need. And if you just put it into context, our average debt service costs at the moment are, so if you take our budget every year, just to pay off our debt on that budget is about 21% at the moment. So 21% of the Treasury's budget every year just goes to paying off our debt. But you can see it's still lower than like India, for example, than Egypt, for example. So it's not, it's bad, but it's not. And if we can see this coming down, obviously this will improve. Big one, like I said, you know, government compensation of employees. So if you look at, you know, the sort of average on OECD nations is about 10% of their government expenditure goes to government employees. We're setting about 15%. So, you know, looking at tackling that wage bill can be a big win for us. I think it could be a quick win for us. So if we can get this agreement at the 1.5%, and it looks like it will be, that's encouraging that we can at least start some sort of fiscal austerity in that direction. So like I said, it's about the trend. Revenue since COVID is better than what's been thought. So revenue, like I said, has also improved, and a big part of this is due to commodity prices. So you can't really give the government credit for this one. 2020 budget, you know, that was what was projected before COVID. Then in June, you know, well, at the end of the year, you had the budget speech last year. That was during COVID. That's what they projected. So they projected a sort of revenue fall as we went into lockdown and then a recovery. But what actually happened in the budget is you're actually seeing more of it was less of a fall than what we thought, and then the recovery. And part of this was due to the economic damage of the lockdowns not being as bad as what was initially thought, but also this mining revenue that we are getting is a nice windfall. I do think mining revenue going forward will continue to be a windfall for some time. You know, you've got increasing demand for commodities. So this is steel demand, for example, increasing demand for steel. But if you look at CapEx is flattened. So if you look at the blue, that is growth CapEx. So that's expenditure into new projects, non-existent. So all the CapEx is going into sustaining existing infrastructure. So as you've got increasing demand, supply has not caught up. So you will see increased sort of commodity prices. I think particularly iron ore and platinum, you've seen massive windfalls in our platinum stocks, big bumper dividends, free cash flows. You'll probably continue to see that. And those companies, they've got to pay tax, and that's where you're seeing this increased revenue coming from. So just at current spot prices on some of our export commodities, you're looking at about an extra 100 billion rand into the fiscus, just the current spot price for 2021, which is quite interesting. But long term, we've talked about the corruption reform, we've talked about the institutional reform, but we need policy reform as well, and we need the ANC government realizing and coming more to the center and realizing that business is not the enemy, and to encourage entrepreneurship. There's some easy wins that they could do. If they just loosened up labor policy, labor legislation, for example, that would help us. If they just cut away some of the regulation and the red tape, that would obviously help us. And I think before these riots, I think there was an ideologically defensible position. I think after the riots, it's a less defensible position. And I think you're seeing amongst their own electorate as well that it's becoming less and less defensible, that position. And you're seeing it already slowly with Ramaphosa. Now he's probably been a bit slower than any of us would like with his reforms, but he is going in the right way. Like I said, you got the SAA being privatized, you got the Eskom, the self-generation being upped. Those are actually quite big ideological stances to take. So if you see, our GDP going forward, it's projected to be quite lackluster. These are the National Treasury forecasts. Personally, we projecting GDP to be slightly better than that. Obviously, it's going to be a bumper this year. It's already looks to be better than that from the last numbers, and then better going forward than just because of the mining. So I think the mining revenue will help you out quite a bit. And obviously getting our costs down. Obviously, budget deficit growing in 2020, 2021, and then forecast to narrow. And you've seen, obviously, the debt to GDP numbers looking a lot better than they were last year. So a few wins for us. I think a big win, this is the leading business cycle indicator. So this shows you what sort of economic prospects are going forward. And you can see this should rise over time. It's a nominal indicator. But you can see over the last decade, you can see our economic prospects. There was just nothing that was good that you could look forward to in the country. But there's been a big bounce in sort of the leading business cycle. And this is quite predictive, actually, of economic. It's got quite a high correlation to what actually ends up happening in the economy. And you can see what these are the things that go into this indicator. It looks at things like number of building plans approved, job advertisements, money supply, the spread of our bonds, business confidence. Big one, operating surplus, business cycle indicators from our major trading partners. We are still a very open economy, so we export and import a lot. If they're doing well, generally we're doing better. Hours of factory workers. So if you combine all this into an index, it gives a good idea or a good picture of the buoyancy of GDP going forward. And you can see we're due for quite a pickup in GDP. And I'll show you some of the numbers now. But we're due for quite a pickup in GDP, and it's not something we've seen. If you say this was the last Zuma decade, it was flat, it was lackluster, it was actually decreasing, but a nice kick going forward. And I think this could be very positive, more positive than I think people are giving or thinking about. So yeah, quite positive. We'll obviously continue watching this and see what transpires going forward. But at the moment, quite a nice tailwind for the SA economy specifically. If you look, GDP, like I said, 4.6% Q1. This came out in July. It was estimated at 2.7. So that's actually a big beat. That's a 2% beat on what economists thought it would be and what it actually was. The inflation rate over this time actually lowered to 4.9 from 5.2% in May. So inflation, not really a problem, a little bit higher than where we'd like it to be in the sort of midpoint at the 4.5 range, but nothing to worry about in terms of interest rates. Average expectations of future inflation about kind of at the midpoint. The July Monetary Policy Committee kept rates at 3.5%, still very accommodative, very low. So if you look at the QPM, the SARB's QPM model, they're predicting maybe a 25 basis point increase in the fourth quarter of this year, and then in each quarter of 2022, maybe 25 basis point each chance. So that's quite hawkish. they're forecasting kind of rates being raised quite significantly from here. Whether that transpires or not, I still think will be determined. I'm not as hawkish as they are. I think inflation is going to be more muted than what they think. But even if we look at this as a baseline, you can see still very accommodative. So before this is before COVID, even if we get all those increases, still very accommodative monetary policy and and still kind of below levels that were seen pre-COVID. 3.5% is very low, very accommodative repo rate where we're sitting at the moment. So we'll see how this pans out. But bottom line is, if we do start seeing inflation tick up a bit in interest rates rising, it's not going to cause a massive sell-off in our asset classes. And I'll explain why now. So if we look at our asset class outlook, the first thing is very important to understand is that our yield curve is exceptionally steep. And it's actually the steepest it's been in a long time. It's actually the steepest it's ever been. And how you get this is you say, what's the 20-year yield minus the 2-year yield? And you get this graph. So you can see in times before, we've actually had an inverted yield curve. So what this is saying is that the yield on a 20-year bond is about 6.5% higher than the yield on a 2-year bond. So a lot of uncertainty around South Africa's future economic situation is priced into our bond market, probably more than priced into our bond market. So you're seeing, because the market is saying, well, we don't want to buy too many of our bonds, or we don't want to price too little risk in because we're unsure of what's going to happen. But as we are lucky because we are being rewarded, it's a risk we are willing to take, and we think we're being more than compensated for taking on that risk on the long end of the bond market. You're just getting very juicy yields there. If you look, compared to, this is the SA yield curve, you can see how steep it is. That's compared to the US, and then obviously compared to Europe. And you can see on the long end these differentials: 9% differential to the US, 11% differential to Europe, based on 25, 30-year bonds. It's just very big numbers. They're not as lucky as we are. They can't go and invest in their own bonds and get any kind of yield. There's just no yield there, whereas we're still getting very decent. It's a very good diversification benefit for us to hold income instruments. If you can see, the other thing is, the foreigners have already sold out of our bonds. So if you look 2017, they owned about 41.5% of our bonds. If you look now, they own under 30% of our bonds. So that slack has already been taken up by sort of unit trust companies, fund managers, and the banks. So they're who's holding all this debt. I laugh, I use the analogy, and a lot of people say, well, keep your money in the bank. Well, the banks own a lot of the government debt anyway. So if the government were ever to default on its debt, we put in a very low probability, a lot of things have to happen before that. Some of your biggest holders of that debt are the banks, or where you're keeping your money in the money market anyway. So it's a bit of a funny one. But yeah, you can see if foreigners start to come in, even if they start to get rates increases on their side, they're going to start looking for more opportunity to get a yield pickup. Because what you'll probably find happening is you see rates being increased, but the reserve banks, the central banks, will still keep long-term bonds low with quantitative easing, like they've been doing for the last 30 years, because they want to keep they want to stimulate, they want to keep their cost of debt down. Keep those interest rates low. So it's an interesting dynamic. So you could see that interest rates rising in the developed world might actually be a catalyst for foreign investors to start investing locally, because we have so much fat in our bond market. If you look relative to our peers, our real rates, so our bond rate minus inflation, higher than all of our peers. So even if you start seeing inflation locally, which we're not sure you're going to see, we've got so much fat built into the system. Our real yields are so big. If you just do a quick rudimentary valuation, you take US Treasuries. So US Treasuries is the blue. So that's the 10-year bond yield on the US bond. Then you add the inflation differential. So obviously we've got more inflation than them over time. So you add that, and then you add the fact that we are not, our risk of default. So take the credit default spread. So that is, they're a triple A rated bond. We're a sub-investment grade bond at the moment from the rating agencies. And you add all those up, that's where our bonds should be trading. That's where our 10-year should be trading. But our 10-year is trading here. So it's offering you a much higher yield. It should be based on parity, yielding about 6%, and it's yielding about 9%. So it's got a massive, if you had to value it, based on sort of first principles. So you can see the market's not expecting great things from South Africa. So all we need is a few wins in the right direction. You could see this improving. We've had times where, I'm not saying this is going to come down, you're going to see this big rally in bonds. But if you've got a pickup in inflation, for example, like what we had here, you've got a pickup in offshore bond yields, you're not necessarily going to see our bonds rising because they haven't in the past. Bond yields have actually been quite consistent throughout this. So you get your capital kind of ups and downs, but generally they anchor back to the yield because that is what a bond is. A bond is essentially you lending and you're getting a return. And then they generally always go back to par by the time they mature, and then you get your capital back, And so barring any default, that's kind of what happens with bonds. So, if you look at it, just look 20 years back, and you say, well, the income on bonds over the last 20 years, the income, what you got from actual yield, income payments was 9.4%. And the total return of the bond was actually 9.2% because there was no return from capital, really. Capital return just kind of, it ebbed and flowed, it went up and down, but you just locked in those returns. So, we still, if you see where bonds are now on the longer end, you're still getting, 11, 12%, almost equity-like yields in that space. If you look at it, this is where kind of the all bond is at the moment on a yield. So the yield of the all bond at the moment is just over 9%. And you can see historically, well, if you started at that level, what could your next 5-year return expectations be? And anywhere in the range of about 7.5% to 13% a year is where we expect that you'd still get by just holding those bonds. And if you did get some kind of pickup here, that could be significantly more. Not that we are expecting that, but it would be a nice kicker. But you see, even if if you start getting increases in inflation differentials and things like that, doesn't necessarily affect the yields long term. Just a note on the rand. So if you look at the orange, that's the rand dollar exchange rate. If you look at the black line, that's a sort of real rate. So that's kind of more adjusted for parity, adjusted for inflation differentials. So you can see above the line is a weak rand, and then below the line is a strong rand. So you can see, the rand weakened quite substantially in the initial throes of COVID, of the lockdowns. That was just due to a risk-off trade. It happened in 2008. Whenever you get a risk-off trade, you see a massive weakening in the rand. But then it slowly, as sort of the outcome globally was better than what was originally predicted, you've seen a sort of strengthening of the rand slowly back to parity. And it even actually strengthened. It got very strong. We were sort of underweight offshore through this period, just, because we thought that the rand was just too undervalued. And it kind of turned out to be the right call, and you saw the rand strengthen quite a lot, and then of late it's weakened a little bit. It's gone back to fair value. So you're seeing a sort of the last few weeks a weakening in the rand, but I wouldn't say it's anything to worry about. It's just the rand was a bit overvalued. It's going back to sort of parity levels. A few reasons for this. One is the Fed pivot, so it became slightly more hawkish. Like I said, it wasn't originally predicting no rates for 2023. Now it's predicting like 225 basis point rates up until 2023. Still extremely accommodative, but that could be a reason for this slight shift. And then obviously the riots over the last few weeks, we've seen a sort of shift, but really going back to sort of fair valuations. I still think I'm still quite constructive on the rand in the short to medium term, just because of the trade surplus. So the current account surplus in South Africa at the moment has just been very surprising to the upside. It continues to surprise to the upside for the last few prints. It's at about 5% surplus to GDP at the moment. And that's quite supportive for the currency, because obviously it's very much because of the commodity exports at the moment. So what you're seeing is, as we export the commodities, there's demand for rands to buy the commodities, and that's what you're starting to see. So you're seeing a big sort of trade surplus. So that could be quite good for the rand, just from a trading point of view, just from a complete fundamental point of view for the next few months as well. If we look at equities, so you had equities on a PE basis quite expensive, but as you've seen, this rapid sort of recovery in South Africa, you saw the numbers, 4.6% annualized growth. You've actually seen earnings surprises across the board. Corporates have actually held up really well throughout COVID. You've seen massive earnings increases. So you've seen a sort of re-rating in the PE coming down over time, and it should continue to come down. And it's not a price re-rating, it's an earnings re-rating. So prices have continued to be quite buoyant, but you're getting PEs dropping just because earnings coming through are so powerful. If we look at forward earnings, so our forward earnings are actually expected to be about 9.8% 1 year out. So the price of the current all share versus forward earnings is actually quite cheap. Now, if you compare that and you look at local equities over the last 5 years and you say, geez, it wasn't a good place to be, it was because, if you look at price to forward earnings, they were quite expensive. In 2014, 2015, 2016, 2017, you had quite an expensive market based on earnings expected 1 year out. And that has come that's come down quite a bit. So equity is looking a lot cheaper, back at levels last seen at the GFC. And, we had a massive bull run recovery after the GFC, and lasted for quite a long time. So quite interesting that equities are actually showing quite a bit of value from local equities from a valuation point of view, a lot cheaper than definitely the developed market equities are. So, okay, well, what about the impact on retailers over the riots? So retailers were impacted. About 10.5 billion retail was impacted, estimated impact on the retail industry. About half of that was in the listed companies and half of that was in the sort of smaller businesses. So if you look at it, you look at a percentage of these are the big retailers in South Africa, the big listed retailers. As a percentage of their stores, these are the kind of stores that were impacted by the riots. So although it's significant, it's like I say, Sasria is going to cover this, and I do think small portions of their portfolios, and I do think you will actually see them in a stronger place after they've recovered from this and rebuilt. And that's why you didn't see much movement in the markets. The markets were actually quite sanguine, quite benign over the riots. And it's because I think, the markets realized it was a short-term thing. And even through this month, the funds are actually doing really well this month. They're all up quite significantly this month. So although we had this kind of concern and there are things to worry about from an investment point of view, the market seemed to be able to sort of take it on the chin. We still like property. It's done well for us. We have recently down weighted, but we still like it. Still discount to NAV. Dividend yields have recovered now that, the lockdowns have eased and you got people paying their rents again. So dividend yields have recovered. They're quite strong and still offering a nice discount. If you look at, well, what about the impact on the property companies of the riots? About 9.3 billion estimated in rental losses. If you look at the, percentage of some of the big listed REITs in the country, property companies in the country, you can see Vakile was the hardest hit. That's just a demographic thing. It owns a lot of sort of your kind of lower end properties. But I mean, if you look at like Growthpoint, for example, only 0.7% of its portfolio is actually harmed at all. So pretty, like I say, pretty manageable in terms of the whole REIT industry or the REIT environment. So like I said, I'll come back from this. I'll bounce back from this. So just getting into the fund positioning, as you know, the supporters of us, the people who have been with us for a while, what we're trying to do, we risk managers first before we return managers. And what we're trying to do is, across our funds, we're trying to sort of achieve a CPI plus outcome. So that would be, that would be the perfect scenarios. If you could just get a straight line of CPI plus and then everyone be on their merry way. And obviously that's what you when you're modeling with your clients or what you're trying to achieve a CPI plus outcome essentially when you do your planning. So what we are trying to do is do that, but with less volatility. So you can see you got massive volatility. If you got big volatility, what happens is you got big emotions, you got good emotions, you got bad emotions, and that can create you or entice you to make the wrong decisions at the wrong time. So whereas we're not going to eliminate volatility, we'll still have volatility. We're trying to minimize our volatility and manage that risk from a behavioral point of view and to still come out with a CPI plus outcome. So this is just a practical example. This is a global flexible, it's a local flexible fund, the orange fund. It's a real fund in South Africa. Can't tell you which one it is. And the black is the high equity category average. And you can see this fund has done well. It's beat its benchmark. It's done what it set out to do, but it's the cost of it's been very volatile. It's had times of outperformance. It's had times of underperformance. And these are the flows into this fund. So you can see when it started pretty much in line with the market, sort of market-related inflows. Then it started to outperform. And you saw people starting to chase this outperformance. You saw a lot of money flowing into this fund. Then it started to underperform. And then you started at the top. So at the top, you had all this money that had just flown in. And then it starts to underperform. And you see all this money starting to come out, especially during times of panic and during times of market bottom. So what essentially happened is you had all this money coming in here at this level, and then all getting sold at this level. So buying high and selling low. And it's because of this, these swings, and it's because of these emotional kind of reactions to things. So what we're trying to do is we're just trying to say we still want to get these returns, these inflation plus returns, but by managing our risk a bit better. So if you look at our global flexible fund, that started in October last year. Over the last quarter, it's done just over 2.5%. It's up about just under 4% for this month. We can't show you those numbers yet, but having a great month. Kind of quite well ahead of its peer group average. Return since inception, 8.7%. But these are the things that we pride ourselves on is the risk measures. So the standard deviation numbers in the drawdown, significantly lower than the peer group. That's what we want to do. So we want to get the returns, but we also want to manage our risk. This for us is more important. The risk management is more important than the return management. So you can see the orange is our fund performance versus its peer group. Very good performance and managing the risk really well. If you look at where we are from an asset allocation point of view, got about 49% in developed market equity at the moment, now about 19% in emerging markets. So quite significantly up weight in terms of emerging markets at the moment. We got that offshore property that I talked to you about. It's done very well for us when we continue to hold it. And then some offshore credit and bonds. So we hold those as a hedge. So although bonds aren't yielding much at the moment, bonds have actually been a good place to be over the last few months offshore, just because we still got those massive injections of money and almost a put on that bond market. And if you ever were to see a sell-off, let's say there was a risk event and you'd see a capital market sell-off, bonds are always going to provide a good diversification for that overseas. There's a sort of negative correlation there. And that's how we sort of manage the risk. If you look at some of our holdings, we've got sort of specialist property managers in there. We like to hold the broad market type indexes, keeping the costs really low and really just focusing on the asset allocation and the risk management. It's quite happy with this fund and what it's done. If you look at income over the quarter, 3% for the quarter, CPI plus 1.5 is what we're trying to do here. So we're beating that. Since April last year, since the fund started, we're up 10.6% in this fund. Peer group's kind of up 9.6, so about a percentage ahead of the peer group, way ahead of our inflation target. And the yield on this fund at the moment is just over 7%, 7.23%. The average yield on an income fund at the moment, just the general income fund out there, is about 5.4%. So quite a significant yield pickup and still keeping the duration quite low. So it's kind of managing the volatility. You can see it's fairly obviously stable. That's what you want out of income. It's not a money market account, but still stable and giving you a decent yield and good returns. And how we've done that is we're using sort of kind of a lot of different strategies. So, we build our portfolio with expertise from other funds. The income space is very, very dynamic and very complex. It's more complex than the sort of asset allocation space because you got credit, you got different credit on the spectrum. You got fixed rate, you got floating rate, you got inflation linked, you got derivatives, you got swaps. There's a lot that goes into it. So we try and build our portfolio by using different funds with different expertise in order to get our overall portfolio. So BCI Income Plus's expertise will be very different to how SASFIN manages money in the income space. If you look at the asset allocation, we've still got a lot of cash for downturns. And then in our bonds, about 30% would be government bonds, and then about the rest, 36% would be 46% would be floating rate credit. If you look, we still own a bit of naked bonds. So we got the Ned Group Core Bond Fund here, and that's just a naked bond. So we're holding that just because you've got such juicy yields at the long end. You've got upwards of 9% yields there. So it gives us a bit of a yield pickup, but we still, it's a very small holding. So we manage the risk, we manage the volatility really well around that. If you look at stable, so stable, doing what we wanted to do over the 3 months, up 2.2% over 3 months, in line with where we want to be with inflation. Even though the markets have flattened quite a bit over this time period, if you look, the return, it's behind the peer group, but if you consider, since we started in April last year, equities have run 40%. That's not going to happen all the time. But as you start to see equity markets normalize, you'll start to see the value coming through a little bit more. Like I say, important to us. So we're still getting the returns, very good returns, but the important to us is the risk minimization. Significantly lower standard deviation, significantly lower drawdowns. What we hold, so we hold our own global flexible fund, and that's the offshore component to all of our funds. But if you also, we run a similar kind of strategy across all our portfolios. So all our multi-asset portfolios, we hold the same funds, we just hold them in different weightings to get the different asset allocations out. But just a few sort of standouts. If you look at our active equity funds, so Resco Equity and Blue Alpha Equity, they are both low beta type funds. So they don't run as hard as the market does, but they also don't sell off as hard as the market does. if you look at the recent volatility coming out of NASPERS and what's going on with tech in China, NASPERS falling almost 20% in 2 days. It's recovered subsequently, or not fully, but it's recovered a lot of that. We avoided that risk. Neither of these funds own any NASPERS, for example. So we still have exposure to NASPERS, through our index tracking. So core shares, that's a top 50 index tracker, but that's capped NASPERS at 50%. If you look at our smart beta fund, equity fund, that's also got a bit of NASPERS, but our overall NASPERS exposure, we didn't even really notice that drawdown, just because, by having the right strategies in place that sort of are able to correlate well with each other, we can avoid a lot of those idiosyncratic factors, So it's not that we have a view against NASPERS or not, it's just that we manage our risk around those kind of factors. If you look at the asset allocation, so we still hold a lot of bonds. We're fairly conservative in equity. If you look 20% local equity, although we like equity, we're about risk management first. So we're about 20% local equity, another 9.5% offshore equity. Still hold quite a bit of cash. We still got local property. We're up at about 5% here. We've brought it down to about 3.3% at the moment. Property has done very well for us. It's still, we believe, cheap, but we've just taken some money off the table and banked those profits. And put that money back into bonds, where we think the sort of differentials, we like bonds and property. We just think the risk return metrics on bonds are better at the moment. So we've taken some of that profit off. We left some for potential sort of higher upsides. And we've got some offshore bonds as a hedge. If you look at moderates, kind of same story. So over the last quarter, about 2.5%, quite far ahead of the medium equity benchmark, kind of in line with where we want to be from an inflation point of view. Since our inception in April, slightly behind the benchmark, but as I mentioned, that's because of the big run in equity. But what we do really well is you see in the drawdowns, we're protecting those drawdowns a lot better. We're trying to avoid that volatility. So max drawdowns a lot lower and standard deviation significantly lower. So the same theme across our funds that you're seeing. Same holdings as our stable fund, just in different percentages, as I've mentioned. Where we are on our asset allocations, domestic equity about 29%, offshore equity about 12.5%, so about 41% in equity. Still fairly kind of, definitely not at the, you can go up to 60% in a medium equity fund. So we're quite well off below that. Still hold quite a bit of bonds. We like the income mentioned before. We've got quite a bit of cash. We still hold some property, a little bit more than in the stable fund, but have taken some property off the table. And then recently, and then some offshore bonds and cash as a hedge. Manage the same thing, so about 2.6% up for the quarter, quite significantly above the high equity benchmark. So what you've seen is, since April last year, we've done really well, 20% up, but trailed the high equity average quite a bit. But you can see when markets start to flatten a bit, that's when you really see the value coming out. So quite significantly above what the average fund did in the quarter. So we've sort of given up a bit, but you'll start to see that come back. I think if you see more volatile, you're not going to see probably not going to see another 40% move from here over the next year that you saw the last year. But standard deviation, again, protecting our risk, protecting our drawdowns. That's where we want to be. So we still, bottom line is, we're still getting the returns we want. We're still getting very decent returns for our clients, but we're protecting this risk, which to us is very important, because when you sit in front of your clients, that's what you want. You don't want to, you want to be able to give them the returns and still protect a little bit. Not to say that we, if there's a big drawdown that we're not going to feel it. Of course we'll feel it, but hopefully to a lesser extent than our peers will. And you can see, in this drawdown, for example, we will come down. If there's a big equity sell-off, we will drop off, but less so. If you look, what that looks like, we own about in domestic equity about 36%, and in offshore equity another 16%. So if you combine our equity, we had about 52%, which for a high equity fund is quite low. High equity funds can go up to 75% in equity. So although we like equity, the risk management comes before that. We're not trying to maximize returns. We're trying to maximize risk-adjusted returns. So we'll hold about half the fund in equity at the moment, and then we still got our hedges with our bonds, with our offshore. We've got a chunk in property. We still like property. It's got good yields, so 5.3% there. So similar kind of theme to the rest of our portfolios, just obviously in different weightings. What we judge ourselves on is a lot of fund managers will show you quartile performance, and they'll say, well, we will first quartile performance. What they don't show you is, the risk they took on to achieve that. So for us, it's much more important how we judge ourselves, or we judge ourselves on the risk metrics. So we judge ourselves on the Sharpe ratios and the max drawdowns. So a Sharpe ratio, it's essentially your return. How much risk do you need to take to get the return you're getting? So the higher your Sharpe ratio means the better your risk-adjusted performance. So it's Sharpe ratio is your return minus your risk-free return, which would be like cash, divided by the standard deviation of the investment. And you can see that we are top quartile across all of our portfolios. And that's where we want to be. So this for us is good. It tells us that we're doing our job correctly. So we're not giving up a lot of the upside in strong markets. We're still getting the returns, but we're managing the risk really well. And that's what we want to see. If you look at max drawdown, same thing. Now, obviously, since we launched our funds in April last year, markets have been very kind. Markets have been one way, and that's up and great. And we hope for it to continue. We hope markets continue to go up. That would be fantastic for all of us. But we want to manage the risk. So although drawdowns have been muted through this time, you can still see there have been some high equity funds with significant drawdowns through that time. But also what we're trying to do is we're the orange block. We're just trying to sort of stay in that first quartile. So keep, our drawdowns in the first quartile. So it's not to say we won't have drawdowns, but it's just we want to have our drawdowns lower than our peers. And that's what we're trying to do over time. So I think that also ticks the box for us. It shows us that we're achieving what we want to do. So thank you guys for your time. That's pretty much it from me. I really appreciate your time. As Jess said, if any of you need to go, you will get your CPD certificate. We're just applying from to the FPI, and that will be out in the next probably few days or few weeks, and you'll get your certificate. Anyone who wants to stick around for any questions, you're welcome. But the rest of you, thanks very much, and hope to see you in person soon.
Thanks, Paul. Yeah, if there's any questions, please pop them in the chat box. I don't see there is any at the moment, but just from our side, Paul, we are really proud of our global fund and how it's performed. But we are quite underweight in the rest of the funds where we do make use of our global fund. In what scenario will we necessarily up that weighting to offshore exposure?
Yeah, so our offshore exposure, we can sort of go a little bit higher offshore across all of our multi-asset funds. The reason we haven't yet is, first of all, I still think there's quite a lot of support for the rand. But if you take that out of it, I've shown you the trade balances. But if you remove that out of it and you just look at the rest of the picture, you're looking at US equities being very expensive, like I've shown you. So we don't actually see a lot of potential in US equities, although US economics, US is going to fly this year, next year. The backdrop is awesome, but a lot of that is in the price already. You're seeing that very expensive equities. If you look at equities in the rest of the world, a lot cheaper. But in Europe and Japan, for example, the developed world, economic growth has just been lackluster for decades. And I've shown you the demographics earlier in the presentation. We just don't see what's the case for sort of massive outsized corporate profits from here. So although things are looking relatively cheap, we don't see a lot of opportunity. So it's almost the reverse from what's happening in the US, whereas the US is a lot of opportunity, but you're paying up for it. In Europe and Japan, there's less opportunity, but it's cheaper, but there's less opportunity. We like emerging markets, but if you think about it, South Africa is an emerging market. So, we'd rather say, well, instead of taking the currency risk, for example, why don't we upweight local equities a little bit? Because you must remember, emerging markets are the same things. They're commodity exporters. The miners are going to do well in times of when commodities run. We own a lot of miners, so we can have exposure to the miners locally. We've got the best platinum miners in the world, for example. So it's more a case of, if I can manage, we're about risk management first. We're not about trying to maximize returns. So if I can avoid some of the currency risk by investing locally and still taking an emerging market call, we'll do that. So some of our upweighting in equity that we've had over the last while is actually an emerging market call rather than just a specific SA call. SA stocks are more than 50% of our revenue is generated offshore anyway. So it's not really a call on local economics. So I hope, I don't know if that answers it, but if anyone wants more detail on that, we're happy to send them some info. But it's really a risk management call at this point.
Cool. Thank you so much, Paul. Yeah, I don't see that there's any questions in the chat box, but if you guys do have any questions that you think of in future, you're more than welcome to contact us. And thank you really for all of your time. And thank you, Paul, for your time as well.
Thank you, guys. Hopefully see you all soon. Ciao, ciao.
Thank you. Bye.